Doing well. Hope you're ready for a Wednesday morning webinar. So this morning, we've got a very good friend of mine, Monty, is going to be going over some stuff that'll really help you. So Monty is the Director of Annuities and Securities here at Secure. And so what he does is all things retirement planning. So he does any securities and mutual funds, stocks, bonds, as well as all the annuities and fixed indexed annuities, and doesn't do any variable annuities, but any fixed products or MIGAs. He also does large life cases, long-term care, all of that stuff. So anyways, Monty's a good buddy of mine. He is going to be hosting this training. So Monty's going to go over the power of indexed universal life insurance and what it can do for you and your product portfolio. So Monty, take it away, sir.
Hey guys, glad everyone jumped on today. All right, now, can you hear me now? All right, sorry about that, everyone. No, I was just saying that we've got some really good I.U.L companies that we use. The one I like a lot right now is F&G. They're an A-rated company. They've been around about 80 years or so, and they illustrate really well, and they performed really well over the last 10 years with their Barclays Index. And I think most of you probably know this, but the I.U.L is really an amazing tool if you use it properly. Several uses that you can put it to work for. What we're going to look at today is adding some tax-free income during your retirement. We're going to do a quick case study. Once you get contracted with these different companies, you can go in and log into their website and do your own illustrations. I do a lot of illustrations for people out there. So if you have questions, you need an illustration done, just get in touch with me and I'll take care of it for you. I myself like to do my illustrations as much as possible. That way I don't have to wait on someone, to get it back to me. So I'm going to illustrate in F&G's website today. You'll just log into their homepage as you see right here. Then you're going to go to Sales Tools, click on Illustrations. Then you click on the F&G Online Illustration website, and this is what pops up. Okay, so you're just going to start a new case. F&G's website's always a little slow. I apologize for that. So our first case study, we're going to do a 25-year-old male, non-tobacco, and we're going to show him putting in $200 a month, and then we're going to also show him putting in $500 a month. Pick what state you're in. These are very simple to use once you get the hang of it. When you're starting out, just let me know, and I will jump online and go through a little tutorial with you. What I use almost every time right now is the Path Setter. It's designed more for the bank on yourself or the tax-free retirement income. All right, so getting everything put into the software is very important, and that's the tricky part when you're first starting out. So he is 25, non-tobacco. First thing we're going to do is solve. In this scenario, we want to solve for max accumulation and income. We're always on this, when we're trying to show the retirement income, it's going to be solved for face. You want to put monthly payments. Obviously, if they're doing annual payments, you would choose that, but he's doing monthly. And we're going to show him $250 a month. All right, so now some important parts here. So if we want to pay this to age 65 and then start drawing income at age 66, this field here, we'll just put A for age 65. One of the most important parts of this policy, in order for everything to remain tax-free, is this has to have cash value and a death benefit when the person passes away, in order for it to remain a life insurance. If they withdraw all the money from this at some point, or if they pull too much out in retirement and the policy runs out of money, then at that point, everything that they pulled out above their contributions becomes taxable. So it's very important. We want to design this to have $1,000 cash value all the way up to age 120. People are living longer and longer today. We just don't want somebody to be 105 years old, their policy runs out, and they've got a $500,000 tax bill. We're not going to change anything on the income type. It's going to be loans. They're going to pay it monthly. This scenario, we're going to start the income after age 65 and run it out for 25 years. Okay. The next step you're going to do is on the death benefit option. So option A is a level death benefit. So if the death benefit started at $250,000, it would remain at $250,000 for the life of the policy. This one, we're going to choose option B, going to A, and that means the death benefit will always be the original death benefit plus whatever the cash value is. But we're going to start with option B, switch to option A at age 65. And then when it comes time to choose the index that you want to follow, you've got pretty limited choices. You have the S&P in different forms, point to point, bonus, monthly, things like that. But what's performing the best right now is the Barclays Trailblazer Sector 5. So we're going to put 100% of the money in there. And it's an annual point to point with 145% participation rate with a 1% bonus. And the 1% bonus is what's important, because you'll see the S&P annual point to point has, over the last 10 years, has been around 7.19. The Barclays has been 6.91, but then when you add in the 1% bonus, that's why it performs better. Okay. Once we get that plugged in, we're going to hit view and illustrate. Takes it a second to pop up. Give me just a second. I'm going to have to switch screens that we share. All right. So can everybody see the illustration that popped up? Just give me a thumbs up if you can see it, Brad. Perfect. All right. So this is the illustration that comes up from all of our input. I think it's a good idea for everyone to go through these illustrations the first time or two and just read everything. I don't spend a lot of time when I'm with a client going through all of this. I just explain it as I go. One of the important screens that I do always stop on first things here. So we're putting in $250 a month that you can see right here. The initial death benefit is $173,188. So that's an odd number, but the reason it's going to be that is because we're max funding this policy. We're putting the absolute most amount of money we can for the least amount of insurance. And that's what makes this perform as well as it does. So this is your illustration here, starting on page 8. And you can see where he's putting in $3,000 a year. His death benefit started at the $173,188. After 1 year, he's got an account value of $2,200, so that increases his death benefit. You'll look out here after about 10 years, he's got more money in the policy than he's put in it, which is good. But even throughout these early years, if he needed money for something, he could have access to a loan from his account value. So that's important to always make sure they understand that. So you can see here, we're paying the $3,000 a month till he turns 65. Then at 65, we're stopping the premium payments and we're turning on the income. So in this scenario, at age 65, he's put in $120,000. He's got $646,000 cash value, which is very important. And his death benefit has grown to $819,000. At this point, we turn on his income, and for 25 years, he's going to be able to pull out $71,775 tax-free. Okay, that's huge, especially if you can get someone young to start this policy with a decent amount of money. Even $100 a month makes a difference. But so for 25 years, he's pulling out $71,000. And if you'll look, if he pulled out his last check of $71,000 and passed away at age 90, he's put in $120,000 of his own money into the policy. He's drawn out almost $1.8 million tax-free. And if he passed away at that point, he would also get a $236,000 death benefit that is also tax-free. Okay, so these policies have amazing capabilities. Like I said, if they're funded properly, there's so many uses of this policy. Most of the time right now, I'm setting these up for this actual scenario here. Put money into your 65, turn on an income stream till you're 90. But a couple of other things that are very important with these policies. Let's say at age 45 here, guy's married and he wants to buy a new house. Well, instead of going to the bank and going through the process of trying to get a 100% loan and having to pay PMI and all that, he can bank on himself. All right, he's got $260,000 of cash value, so he can pull out $100,000 for a down payment on his house. It's not going to affect his policy as long as he pays it back. So I tell people to treat it just like a bank. You borrow money from your policy, you set up a schedule where you're going to pay it off monthly and get it paid off in a certain amount of time. If it's a car you're buying, pay it off in 5 years. If it's a house, a down payment, something like that, try to pay it off in 10 years. If you don't pay that thing off, the interest is going to accrue, and it's going to cause problems for your policy. So let's just say at age 45, he took $100,000 out of this policy for a loan on himself. The income, the insurance company is going to loan him the $100,000. So his $260,000 is not affected. It's just collateral for the loan he got. So if the index is getting 10% this year, they're still paying him 10% interest on his $260,000. They don't subtract out the $100,000. So a lot of, what that is called is arbitrage. So he's getting 10% on his money and he's only paying 5% interest. So he's making money even though he's borrowing money from himself. If he passed away at that time, the death benefit's $283,000. They would subtract out $100,000 from that. His family would get $183,000 death benefit. Okay. One other thing I want to show that we can do on these policies. So this is just the regular I.U.L. In January of 2021, the IRS came out and allowed, they changed a rule. It's called Rule 7702. It actually allows you to put more money in and get less insurance. So I want to show you what that looks like. It's going to be different. The policy is going to look a little different if we use the rule of 7702. All right, it's at the very bottom of the solve page. You would just say, yes, I want to use 7702 rates. That's the only thing we're going to change. Let's look at the illustration again. All that's coming up. I'm gonna check the chat. All right, if y'all got any questions, just raise your hand or type it into chat. I'll make sure I get those for you. All right, so this is the same, everything's the same input, everything's the same, except we did change it to where we wanted to use the rules of 7702. All right, so the biggest thing you're going to notice is before our death benefit started at 173,000. Using the rule 7702, our death benefit goes all the way down to 83,000. And where that's going to make a huge difference is we're paying less for the amount of insurance each year, so more money is going in our cash value. So everything's a lot the same during the early years. You're putting in the 300 or the 3,000 per year. Your death benefit's growing. So let's go down to age 65, and you can see this. There's not a lot of difference in this one. If you're dealing with somebody that's putting in quite a bit more money, it will make a bigger difference. But in the previous policy, at age 65, he was drawing out $76,000, or I'm sorry, the previous one was drawing out $71,000 per year. If we use the rule of 7702, it increases what he's drawing out each year. So over time, you know, if he lives the full 25 years, it's going to make a decent difference. So you can see here, paid in 120, starting at age 66, he's getting 76,000 per year out. At age 90, instead of 1.7 million over that course, he's pulled out 1.9 million. Still got the same death benefit. So there's the 7702. If someone's not worried, they've got a big term or they've got some other insurance in place, you can use the 7702 to get a little bit more income once they get older. All right, this is an important page I always go over with the clients here. This shows all of the indices that we can follow. And you can see here, we've got 100% of our money in the Barclays Sector 5. You go across, this shows the bonus right here, 1% bonus, plus that 6.91%. So the index is averaged 6.91% over the last 10 years. But then you add in that bonus, it's showing about 7.91. The bonus is not guaranteed, but ever since this policy was created, they've paid that bonus every single year. That's the main things I go over with the policy. Like I said, it's very important to go ahead and read through this, and so you understand it before you go see your clients. This is going to show you how this performed since 2001 and how they came up with these numbers. So that's on a younger person, a 25-year-old. And like I said, you can make a difference in the young people's lives even by just getting them to do $100 a month. And that scenario we looked at, if they did $100 a month till 65, they're still going to draw out approximately 35,000, 30 to 35,000, which is, you know, at 65, it's not going to be a lot, but that's a heck of a lot more than a lot of people that we see that have now in retirement. One other thing I wanted to show you, with the I.U.L, you're paid on the target premium. Okay, so just because he's putting in 3,000 a year doesn't mean that you're going to get paid on the full 3,000. You know, the depending on what commission level you're on, 90 to 100% or so. So how you can see how you're going to get paid. This has the target. So this is the one without the rule of 7702. He's putting in $3,000. You'll get paid on a target premium of $914. Now the remaining $2,100 or so, you're still going to get paid on that, but you're only getting paid about 2 or 3%. So these aren't, you know, on the younger people aren't lucrative. You're not going to get rich selling a $3,000 policy, but in my mind, I'm helping people have a better retirement and have a better life. They're going to be able to borrow money from their policy as they get older, maybe to put a child through college, buy a house, buy a car, whatever it may be. But if you can just get them started, then at some point you can go down. And if as they get older and start making more money, they can increase the amount of premium they're putting in there. So that was 914 on the regular policy. On the rule of 7702, it's going to be a little different. So you can see on the rule 7702, he's putting the same $3,000 a year in there, but your target premium's only $439. So in a policy like this, you're probably going to make $600 or so. Not going to make a huge difference for you, but if you can do this for a lot of young people, you're going to change their lives over time. That's personally why I'm in the business. Obviously, the insurance business pays us really well, but if my goal is to help people, so if I can help people and I'm making $600, that's fine with me. Nobody ever showed me this when I was younger. I wish they would have. I'd be in, obviously a different position than I am now. But just get these young people started, get them disciplined, saving some money, and you'll make a difference in their lives. The other thing I wanted to look at is to show you maybe on somebody that's a little older. So we're going to change our age to 45. Everything else stays the same. We're going to let's show him a little higher premium, because hopefully, at 45, they're able to contribute a little more. I'm just going to show $1,000 here. I run a lot of these cases with people in this age group, putting in about $1,000 a month, anywhere from $750 to $1,500 a month. So the only thing we changed was the age and how much we're putting in. So we'll just go to the illustrated page. All right, so you can see on a 45-year-old male, non-tobacco, putting in $1,000 a month. Now this is using the rule of 7702 because I didn't change that. Their initial death benefit would be $198,000. So they're putting in $12,000 a year. 10 years in, they put in $120,000. Their cash value is $142,000. All right, so he's got a much shorter time frame. He's only putting in for 20 years. So when he reaches age 65, he's put in $240,000. His death benefit has grown to $665,000. Now the next year, we're going to turn on his income. So starting at age 66, he's pulling out almost $52,000 a year, or up to 25 years. If he passes away before he turns 90, then his death benefit will obviously be a little larger. But in this scenario here, let's look out to age 90. He's put in $240,000. He's pulled out almost $1.3 million tax-free. That's huge because we have no idea what the taxes are going to be in 10 years, 20 years, 30 years. But as a financial advisor and the people I talk to and work with, we just have no doubt that taxes are going to increase. The money in our national debt, the way we're spending money now as a country, there's no way we can keep this pace up without increasing taxes. Actually, Trump's his tax changes are set to sunset, I believe, in 2025. So that means in 2025, the taxes are going up, because they're just going to revert back to where they were before. So there's a tax increase. And depending on who's in charge, at that point, they could also increase them more, and they are talking about it. So to me, having as much tax-free income as possible once you get to retirement is very important, because the amount of your taxable income can also make it where you have to pay taxes on your Social Security. And you can be taxed up to as much as 85% of your Social Security. So planning ahead, starting early, you can avoid some taxes in retirement. In this case here, he lives to be 90. He's pulled out 1.3 million. Still got a death benefit of 171,000. Now, if he lives past age 90, you can see that his death benefit is increasing because his cash value keeps going up. So once he reaches 96, his death benefit's just whatever the cash value is in there. So, but this is a good story to show, like I said, the young people. When you get to the people in this age category, you're looking at real estate agents, doctors, lawyers, anybody that works for themselves. Everyone on this phone call, I would highly recommend everybody on this phone call to look into this if you haven't started one already. And it's never too late. Obviously, the sooner you start, the better. But let's look at the target premium in this scenario here. All right, so this scenario, he's putting in $12,000 a year. Your first year commission is going to be based on a target premium of $3,566. The remainder, you'll get paid 2 to 3% on that. One other screen I wanted to show you is as you notice in the illustration, we're illustrating the 6.91% plus the bonus. But in reality, since this came out over the last 20 years, with the 1% bonus, this policy has actually been crediting 9.57% each year. So it's performed better than what we're illustrating. The reason we're only showing 6.91 plus the 1% bonus is because of IRS rules and insurance rules. They want to temper what we're showing people. So some of you old guys will remember back in the 80s when everybody was selling universal life policies, they were illustrating 12, 14% rates. And if nobody ever went back and revisited those policies, those things started crashing in the early 2000s and are still crashing today because people are getting 4% instead of 12 or 14%. But with this policy, based on the participation rate and the 1% bonus, they've been crediting 9.57% on average. Okay. One last thing we'll take a look at right quick, and we're just going to take away the rule of 7702 on this policy just to show you the difference. All right, so everything's the same. The only thing we did is just make this the normal rules instead of the rules of 7702. So you can see here his income starting at 66 is 48,000 versus on previous policy $51,000, almost $52,000. So there's not a huge change, but there is a little bit. And then the biggest change earlier, his death benefit, I believe, was somewhere around 180, 190,000. With the regular rules, it's around 314,000. So if you got someone older like this that does not have any life insurance, it's probably a good idea just to run the regular rules because they're going to get more life insurance. And there's not a huge difference in the amount of income they start pulling out once they reach age 66. So you look at age 90, or I'm sorry, yeah, 90. He's put in 240,000. He's pulled out 1.2 million. Still got a death benefit of about 159,000. And the key to this, these policies are super flexible. Okay, if these people get a late start, if he says, all right, I want to pay on this till I'm 70 because I'm going to work till I'm 70, and I'm not going to start drawing Social Security then. So you can change all those attributes, and that's in that screen. Got logged out. But that's in the screen where you solve. And instead of putting starting at age 65, you would just put start at age 70, run it out to 90 still. You can run it out to 95. I'll tell you this, there's not a huge difference in running their income out to age 90 versus running it out to age 100. It's just kind of a conversation you're going to have with your client and see what they want to do. They may want to get maximum income early in retirement, and they're okay if this income goes away at age 90 or 85. But you can make all those changes as the policy, as you're going through the years, you can make changes to the policy. Like I said, you can come back and add more premium to the policy. You would have to do a current illustration because you don't want to add so much premium that it becomes a modified endowment contract. Because if that happens, then everything becomes taxable. The key to this is making sure that you stay within the guidelines to keep it from becoming a modified endowment contract. And any changes you make, get with the company and make sure it's not going to affect that. One of the other things that I went over how important it is to make sure it's properly funded. For this to not become taxable, there has to be a death benefit when the client passes away. If they run out of money before, the IRS is going to go back and tax them on all of the gains. So in that scenario we just looked at, the guy put in 240,000. He pulled out 1.2 million. So they're going to come back and send his family a tax bill on $1 million. So you don't want that for your clients or their family. Another use that we've gotten into with the I.U.Ls is the premium financing. That's for your clients that have a high net worth, typically $5 million or more. And it's to help with estate planning. We've worked with a client that had a net worth of about 70 million. If he passed away right now without a plan in place, they're going to let him give away 12 million, no taxes. The remaining, let's call it 50 million, he's going to be taxed at a 40% rate. So that family would have a $20 million tax bill had he not done his planning. So you can use a premium finance case, which is funded by an I.U.L. for estate planning for your high net worth people. There's another premium finance concept called Kaizen, K-A-I-Z-E-N, and it's for your clients that aren't worth 5 million. The net worth is not as important as they have to be high earners, typically 150 or 200,000 or more per year. You can get those clients in on the Kaizen premium finance concept, and it just multiplies what they're giving. So just real briefly, the way premium finance works, we had a client and the amount of life insurance he needed, the premium on that was going to be $500,000 a year. When he went full premium finance, he contributed $50,000 a year, and then a bank loaned him the remaining $450,000. So over 10 years, he's put $500,000 of his own money into this policy. And then in about year 13 or 14, his policy has enough cash in it to pay off the bank loan. So there are a little more complex situations there. We do some of those. I'd be more than happy to help you work on any concept you have. The main thing I want you guys to know is we're available here all the time for you. If you have a question about I.U.Ls, one of the concepts we talked about, please reach out. My email is monty.mccurley, so monty.mccurley @secureig.com. The office phone number is 417 883-9300. So any questions, if you need an illustration, whether it's IULs, annuities, long-term care, anything, please reach out to me. I'll do everything I can to help you. We're here to make you successful. And any questions before we go or anything, just shoot me an email and I'll get back to you. But I really appreciate you guys being on today, and we'll see you guys later.